The Federal Reserve announced this afternoon that they are keeping interest rates the same. The current interest rate will remain between 0.25% to 0.5%, but it did strongly suggest a hike is imminent, fueling speculation for a possible rate hike maybe in December. This comes after the two-day policy meeting, and shortly afterwards, Federal Reserve Chair Janet Yellen made remarks on the decision.
My colleagues and I on the Federal Open Market Committee discussed overall economic conditions and decided to keep the target range for the federal funds rate at 1/4 to 1/2%. We judged that the case for an increase has strengthened, but decided for the time being to wait for further evidence of continued progress toward our objectives. Our current policy should help move the economy toward our statutory goals of maximum employment and price stability.
Rick Newman, columnist at Yahoo Finance, joins us now. Rick, good to see you. So let me ask you, the U.S. Central Bank said the case for an increase in the federal funds rate has strengthened, but they're going to wait for the time being until there is more evidence of progress. So what are they looking for?
They keep trying to convince us that we really mean it. We are going to raise interest rates again someday, just not today. It's really been the same story all year. For people who can't remember the last interest rate hike as much as we've talked about it, that was in December of last year. And it looks like most likely now the next hike will come in December of this year. And, it's pretty simple. They just don't think the economy is strong enough to justify raising interest rates, and they don't have to raise interest rates. The reason they don't have to is because we really have no inflation to speak of. If we saw signs that inflation were intensifying, they would definitely be raising rates, but the fact that inflation is so tame means they can just wait.
She said that she seemed that the economy was doing well. What are some of the code words that investors are looking for when Janet Yellen, someone from the Federal Reserve, comes out? What is this indication? What is this indicating to the markets?
Well, she used the phrase maximum employment, for example. That is one of the Federal Reserve's two so-called dual mandates, and that's the one that's really driving things at this point. Inflation is not really a concern. In fact, if anything, inflation is lower than the Fed would like to see it. It's really getting employment back to whatever you consider to be maximum employment. And even that's not clear these days. We have a very low unemployment rate. It's below 5%. But we have so many people who've just left the labor force that some economists say, that is kind of misleading, that low unemployment rate, because if you had the same number of people looking for jobs as you did 10, 20, or 30 years ago, it would not be 4.9%. It would be something higher, maybe around 6 or 7%, and the Fed would not be saying the economy looks so well. So these are the puzzles the Fed is trying to sort through, and honestly, they're really not much better than the rest of us at figuring out what exactly is going on with this economy.
Rick, what does this mean for the average person with a mortgage? I, of course, am a New York City renter, so it doesn't affect me too much. But will this hike increase, if there is a hike, increase or decrease those rates?
In theory, once the Fed hikes rates, it's hiking short-term rates. So that doesn't directly affect long-term rates, but eventually it would as shorter-term rates go up over time. Right now, I think if you hold a mortgage, and chances are you've refinanced, if you can refinance, to get the lowest possible rate. If you're still waiting to refinance and you can shave your mortgage rate by a percentage point or more, you should definitely do it, and you should do it soon. But I think another thing to keep in mind, it does remain a good time to buy a home as long as you can muster the down payment. I don't think mortgage rates are going to skyrocket anytime soon. In fact, based on the things the Fed said today and other economists have said, we're likely to have very low interest rates for the foreseeable future here. But, we have another sort of grace period when we really don't even have to worry about interest rates moving until December, because the Fed has said they're not doing anything.
She said a couple weeks ago in Jackson Hole that, hey, the economy is doing so well, we might possibly this might possibly lead to a rate hike. And then they didn't hike today. And she actually said her decision not to raise rates does not reflect her lack of confidence in the economy. So it's almost like a head fake today. What happened?
And it's not the first head fake of the year. I mean, the Fed all year, we've been hearing in speeches and other pronouncements from Federal Reserve officials that we are serious about raising rates. They keep trying to convince us that, yes, they are serious about raising rates, but then they keep not doing it. They've been doing this all year, talking it up as if it's a possibility and then not doing it. And, you know, even for most of the year, it's been a unanimous decision not to do it. This time around, it was not a unanimous decision. We saw 3 dissenters. That was unusual. That was 3 members of the committee who said, we think it is time to raise rates. That's actually probably one of the strongest signs that we are getting closer to a rate hike. But I think the Fed has been trying to maintain credibility by saying we really mean it, and then they keep losing credibility by not actually doing what they say they mean. So, you know, they've left a lot of investors confused.
All right, Rick Newman of Yahoo Finance. Thank you, Rick.
Sure thing, guys.